Similarities of the causes and consequences of the 08-97 financial crises.
It has been almost 10 years. Which one of you guys are going to mess up next?
Oh, please. We are not the ones responsible for the 08 crisis. You are.
Oh, what happened in 2008?
Haha.
So, funny story. It was the good old times in America, just another day in the real estate market, and Wall Street was buying off mortgages and making them into CDOs to trade. How this worked was, when a family wanted a house, they would find a broker, who in turn found them the finance they wanted via a mortgage lender. The mortgage lender would then package his mortgages and sell them to Wall Street investors for a good profit. Wall Street would buy millions of these mortgages and classify them and categorize them into CDOs or collateral debt obligations, categorize them based on their recoverability, and sell them to waiting investors for an even better profit. Everyone was happy. There were many investors willing to buy these CDOs due to their high returns, and with the savings glut in the world, the demand for CDOs grew. This demand for CDOs gave Wall Street and mortgage lenders a bright idea: subprime loans, which were loans given to less trusty homeowners under conditions like no proof of income, no down payment, etc. And thus the time bomb was set. With subprime loans being a part of CDOs and some investors legally bound to only invest in AAA investments, AAA insurance companies stepped in to give their rating and thus their assurance to the CDOs. This was okay because if an owner defaulted, insurance company could sell the house, and house prices have been rising forever. Everybody wins. All this was well until insurance companies went over their liquidity reserve and credit rating companies turned a blind eye on the integrity of these companies. The plan fell apart even further when a lot of the house owners defaulted, creating a surplus of houses in the market that pushed the prices down. The happy times were over, and Wall Street investors, mortgage lenders, and investors from around the world who had invested in the global reserve currency of USD were destroyed.
Wow, that was 2 point.
Hang on, how about when they thought throwing around foreign capital was a good idea?
Well, let me remind you the causes of Asian financial crisis in 1997. The slow growth and high liquidity in developed countries and the stable macroeconomic conditions in least developed countries complemented each other, or at least that's what people thought so. The inflow of US dollar to least developed countries increased by 30% compared to 5% growth in world trade. What the developing countries should have done is to appreciate their currencies, but they did not. As a result, there was excessive monetary growth and volatile economy in developed countries. Then why is it a problem? They just didn't have enough foreign currency reserves to prevent the sudden speculation or outburst of currency's depreciation, which led to defaults in foreign debts. 1.5 was an important number. Why? It was the ratio of short-term debts to foreign reserves in Thailand back in 1997. The finance sector in these countries was fairly liberal, but the regulation was weak. The local banks didn't meet the international standards with their low capital adequacy ratio enforced by the governments and lacked legal lending limits. So why is CAR important? Because it measures the ability of banks to absorb losses. Then why were these Asian governments so lenient in regulating the banks' operations? It's because their crony relationships were at stake. Friends and families of politicians were in charge of major banks and firms. These crony relationships encouraged reckless risk-taking, as owners of these banks had the security of a bailout from their politician friends, which of course didn't happen thanks to the IMF regulations imposed after the crisis.
Hang on, that sounds the same.
Both crises have similar causes. It's a shame we didn't learn the first time. The backdrop of the Asian crisis and 2008 crisis was the same: abundant liquidity. Apart from the abundant liquidity, how are they similar? Let me explain. First, people were demanding investments. During the Asian crisis, the stable currencies of developing countries such as the Thai baht attracted foreign investments. And during the 2008 crisis, the roles have changed when investors from developing countries were searching for profitable American investments. When there is a demand, there is a supply. The bankers appeared with their red capes on, pledging together, "Let there be supply." And God, it was raining loans and investments. This phenomenon is technically termed the lending boom. In short, both these crises were created by the increasing demands for investments. It was a savings glut in Asia during the 2008 and the prosperity of Asian economies in 1997 that resulted in these demands. Secondly, excessive liquidity resulted in lax credit regulations. The loosened market discipline was present in both these crises. The demand for investments led to innovative financial products such as the CDOs, as explained earlier. This form of innovation focused on volume rather than quality to increase economies of scale. This common feature of high-risk investments with the false assurance of security was present in both the crises. In 2008, as much as 50% of the loans were subprime. How did these loans get the funding? It was the biased ratings from agencies given to insurers. These insurers were overrated, and when chain defaults occurred, they were in big trouble. The same imbalance was present in Asian banks, in which their assets were long-term and illiquid, while their liabilities short-term. When credit started flowing in, their liabilities increased, but their assets were not enough. In a way, both these crises could be called a banking crisis. The question then becomes, how did these entities operate with such vulnerable loan ratios? Again, this is where they're similar. Both are a result of close relationships within the banks and their counterparts. Rating agencies are paid by insurers and banks to rate them. The crony relationships in Asia mentioned earlier are also of similar sorts. These interrelated ties further complicate the already complex yet highly fragile banking system.
There are not much differences between the detrimental economic impacts brought by 1997 Asian financial crisis and 2008 financial crisis. The asset markets collapsed in both crises. House prices of Asian countries and US dropped in 1997 and 2008. Stock market changes echo the downturn of house prices. The falling of financial institutions and uncertainty about the economy led to panic selling in equity markets. Both Asian and US stock markets dropped during crisis. No matter in which year, pessimistic atmosphere would be created after fast bankruptcies and property price drops. Private consumption expenditure and domestic investment hence declined substantially. Economies contract afterwards. In 2009, 1 year after the start of credit crisis, GDP of US decreased at a rate of 2.8%. In 1998, 1 year after the start of Asian financial crisis, most East Asian countries had negative growth rates too. Since employment conditions are directly linked with economic growth, the economic recession makes the business sector hire fewer, lay off more. Therefore, the unemployment rates of East Asian countries and the US both increased after the financial crisis. Another similar consequence from the two financial crises is the increase of government debts. Due to the decrease of tax income and increase of government expenditure, governments had to bear more debts after financial crisis.
Those were the similarities of causes and consequences of the 97-08 crisis.